More than half of Canadians say they are just one unexpected bill away from financial trouble, and now new laws are about to make things even harder. Imagine waking up to find extra taxes on your savings, rising costs on everyday services, and new rules that quietly take money out of your pocket without warning. These laws are not just targeting the wealthy, they're reaching into the wallets of ordinary families, students, and small businesses across the country. Some experts even warn that millions could face a level of financial pressure unlike anything Canada has seen in decades. Which laws will hit the hardest, and how can you protect yourself? Let's break down the 10 biggest threats. Number 10. Emergency Wealth Levy. Imagine waking up one morning and finding out that a new Canadian law has taken a direct bite out of your savings account. This is exactly what the proposed Emergency Wealth Levy could do. Designed as a temporary tax to help the government in times of national or financial crisis, this measure would allow officials to dip into the accumulated wealth of ordinary Canadians. Unlike regular taxes that apply only when you spend or earn, this levy targets the money you already have, your savings, investments, or even retirement funds. For families who have worked tirelessly to build a financial cushion, the idea of losing a portion overnight feels like a complete violation of trust. This proposal has been described by experts as one of the most controversial financial policies Canada has seen in recent years. The impact of such a levy could be staggering. Imagine millions of households suddenly seeing their hard-earned money shrink without warning. For middle-class families, this could mean having less for education, emergencies, or future retirement goals. For wealthier households, it could trigger a mass exodus of capital, as money flows out of the country in search of safer financial havens. Analysts warn that instead of stabilizing the economy, such a move might cause more instability, driving away investment and creating fear among Canadians who no longer feel their assets are safe. It raises the haunting question: if the government can take from your savings today, what's stopping them from taking more tomorrow? So what can you do to stay ahead if this law becomes reality? Financial advisors suggest diversifying your assets, rather than keeping everything in one place. That could mean spreading funds between different banks, exploring international options, or holding a portion of wealth in liquid assets that can be quickly accessed. Another approach is to invest in areas less likely to be targeted, such as small businesses, essential commodities, or foreign markets. While no one can completely escape the reach of a sweeping policy, staying informed, planning ahead, and taking action before these rules take effect can give Canadians a much-needed sense of control in uncertain times. Number 9. Student loan interest and repayment policies. For thousands of young Canadians, student loans are the bridge between higher education and future opportunity. But in 2025, new adjustments to interest rates and repayment structures are shaking that bridge in ways many students and graduates never expected. Under the updated framework, repayment plans are being recalculated, which means monthly obligations could become higher for certain borrowers, especially those in middle-income brackets. While the government frames these measures as a way to ensure fair contribution, many argue it unfairly punishes those who are simply trying to climb the career ladder. The rising costs of tuition, combined with higher interest, are creating what some call a debt trap, where young professionals feel like they're running on a treadmill that never slows down. The consequences of these changes ripple far beyond just the graduates themselves. When young people are spending more on debt repayments, they delay important milestones such as buying a home, starting a family, or even investing in their own businesses. Economists warn this could slow down overall economic growth, because entire generations will have less disposable income to circulate in the market. Add to this the already heavy burden of inflation, rising housing costs, and general living expenses, and it's easy to see why so many Canadians feel trapped. Instead of empowering youth to build a stronger future, these policies risk creating a generation weighed down by constant financial pressure. So how can Canadians manage this changing landscape? Experts recommend reviewing your loan terms immediately to understand how much more you may be paying under the new system. Some may benefit from refinancing options, especially if private lenders can offer lower interest rates. Others could look at accelerated repayment strategies, which involve paying off the most expensive portion of debt first, saving thousands in the long term. Creating an additional income stream through side hustles or freelancing can also help chip away at loans faster. Most importantly, young Canadians should stay connected to credible financial advisors and student associations that track policy changes closely. Knowledge, preparation, and strategic action will be key weapons in fighting back against these heavier repayment demands. Number 8. Stricter banking regulations. Banks are often seen as the safest place to store your money, but with Canada's new banking regulations, that sense of security is facing serious changes. These laws introduce tighter controls on deposits, withdrawals, and money transfers, both domestic and international. While the government promotes these updates as necessary to prevent fraud and money laundering, everyday Canadians may feel the real impact through new fees, added delays, and more complicated verification processes. Imagine trying to transfer money to a family member abroad, only to be held up by days of compliance checks or unexpected charges. For small businesses that rely on fast and reliable cash flow, these obstacles could make it harder to stay afloat, turning one simple transactions into frustrating battles with red tape. The broader concern is how these rules affect the average customer's financial freedom. If accessing your own savings becomes more complex, people may start to feel like their money no longer truly belongs to them. Analysts warn that stricter regulations could push Canadians toward less regulated alternatives like cryptocurrency, potentially creating a bigger shadow economy instead of solving the issues these laws are meant to address. And with higher operating costs passed down from banks to clients, many households will likely see increases in monthly service fees, transfer costs, and penalties for even minor errors. For families already dealing with rising inflation and heavier tax burdens, this could feel like yet another squeeze on their wallets. So what can be done to prepare? Financial experts advise Canadians to carefully review their current banking plans and compare them across institutions, as some banks may absorb fees better than others. Using credit unions or smaller community banks could also offer lower costs and more flexible policies. Another option is to maintain multiple accounts in case one provider enforces stricter limits, ensuring you always have access to liquid funds. For frequent international transfers, looking into regulated fintech services might save both time and money. At the end of the day, staying informed and proactive is the best way to make sure your hard-earned money doesn't get trapped in a maze of new banking restrictions. Number 7. Retirement savings rule changes. For decades, Canadians have relied on RSPs, pensions, and other retirement programs to secure their future. But in 2025, new changes to retirement savings rules are shaking the confidence of many working families. These adjustments focus on contribution limits and withdrawal conditions, meaning the amount you can put away each year, or how and when you can take it out, may look very different. On the surface, the government argues this ensures long-term sustainability, but for millions of Canadians, it feels more like a moving target. Imagine carefully planning your retirement for years, only to discover that your contribution ceiling has been lowered, or that new penalties make early withdrawals more expensive. These changes could directly affect how much wealth you're able to build during your prime working years. The ripple effects of these laws go far beyond individual savers. Employers offering pension programs may also need to adjust their contributions, creating tension in workplaces and potentially leading to fewer long-term benefits. For younger workers just entering the labor market, the uncertainty around retirement rules might push them toward riskier investments as they scramble to make up for reduced opportunities in traditional savings accounts. Economists caution that this could create greater financial inequality, as wealthier Canadians with access to advisors and diverse portfolios adjust easily, while average families fall behind. And as life expectancy rises, the gap between what people have saved and what they actually need could leave many struggling during what should be their most comfortable years. So, what steps can Canadians take to protect themselves? Financial planners recommend reviewing your retirement portfolio immediately and exploring whether TFSAs or other tax-sheltered options provide more flexibility under the new system. Building a mix of assets, from stocks and bonds to real estate and even side income streams, can help cushion against unpredictable policy changes. Another strategy is to start saving earlier and more aggressively, reducing reliance on last-minute contributions that may no longer be allowed. Most importantly, stay alert to ongoing policy debates, because these rules are often updated quietly, leaving many unaware until it's too late. By staying proactive, Canadians can hold on to a sense of control over their financial destiny, even in the face of shifting retirement laws. Number 6. higher GST on luxury goods. Canada's new tax policies are turning the spotlight onto luxury goods, and many consumers are already starting to feel the pressure. The updated rules introduce a higher Gulf Standard Time/Hawaii Standard Time rate on items considered non-essential, such as luxury cars, high-end jewelry, designer fashion, and even certain premium electronics. For some, this might sound like a measure that only impacts the wealthy, but the reality is far more complex. Middle-class Canadians who save up for a special purchase, perhaps a once-in-a-lifetime car upgrade or a wedding gift, may find that the cost is suddenly hundreds or even thousands more because of these additional taxes. The message is clear: luxury spending will no longer be treated lightly, and the government is determined to extract more revenue from high-ticket items. The implications of this law go beyond personal shopping habits. Industries that rely heavily on luxury sales, such as automotive dealerships, jewelers, and fashion retailers, are bracing for a slowdown. When people hesitate to spend, entire supply chains, from manufacturing to retail, begin to feel the strain. Small businesses in particular, many of which depend on selling high-end goods to a niche market, may struggle to survive under these new pressures. Analysts also warn of a possible rise in cross-border shopping, as Canadians head to the United States or other countries to buy luxury goods at cheaper rates. This not only drains money out of Canada's economy but also undermines the very tax goals the law is supposed to achieve. So, how can Canadians adapt if these rules touch their lifestyle? Financial advisors suggest being strategic about timing purchases, as promotional events, clearance sales, or duty-free opportunities may help offset the tax hit. Another option is to explore the growing second-hand luxury market, which allows buyers to enjoy high-quality goods without paying premium taxes. Those who regularly invest in collectibles or luxury items might consider diversifying into other assets, like real estate or stocks, that hold long-term value. Above all, the best defense is awareness. Knowing when and how these higher taxes apply can help Canadians make smarter decisions and avoid unnecessary financial losses when indulging in life's luxuries. Number 5. Crypto Asset Reporting Law. In recent years, cryptocurrency has become one of the hottest topics in the world of finance, offering Canadians new ways to invest, trade, and even send money across borders. But with that growth comes more government attention, and now Canada is rolling out a stricter crypto asset reporting law. Under these rules, every transaction, whether buying, selling, or even moving crypto between wallets, could be subject to detailed reporting requirements. For regular Canadians experimenting with Bitcoin, Ethereum, or other digital coins, this means more paperwork, more oversight, and potentially higher tax obligations. What was once seen as a space for freedom and independence may now feel like it's under the constant watch of financial regulators. The new law aims to crack down on tax evasion, money laundering, and unregulated crypto exchanges, but it could also create headaches for everyday users. Imagine cashing out a small profit from a crypto trade only to face unexpected capital gains taxes, or having your account flagged because of insufficient transaction details. Businesses that accept cryptocurrency as payment may also be required to keep more extensive records, raising their administrative costs. Analysts warn that while the government seeks to protect the financial system, these restrictions might discourage innovation and push Canadians toward underground markets or international platforms that are harder to regulate. For investors who once viewed crypto as an easy way to grow wealth, the landscape is becoming more complicated and risk-heavy. So how can Canadians navigate these changes without getting caught off guard? The most important step is to maintain detailed records of every trade, no matter how small. Using platforms that automatically generate tax reports can save time and prevent costly mistakes. Consulting with accountants who specialize in digital assets is another smart move, especially as penalties for misreporting could be severe. Some experts even recommend diversifying into a mix of traditional investments and crypto, balancing growth with stability. While this new reporting law may feel like a setback for financial freedom, being proactive, organized, and well-informed can help Canadians continue benefiting from the opportunities that crypto still offers in a tightening regulatory environment. Number 4. Carbon Pricing Increase. One of the most controversial updates in Canada's financial landscape is the carbon pricing increase, a law designed to push households and businesses toward cleaner energy. While the goal is to fight climate change, the immediate impact is hitting Canadians directly in their wallets. Every time you fill up your car, heat your home, or buy groceries transported across the country, you're paying more because of higher carbon costs. What might sound like a small per liter or per unit increase adds up quickly across an entire household budget. For families already stretched by inflation, these extra expenses can feel like yet another hidden tax, slowly eating away at their monthly income. The broader economic consequences are also significant. Trucking companies, airlines, and manufacturers all pass these higher costs down the chain, making nearly every product in the store more expensive. Analysts warn that rising carbon prices may create a domino effect, leading to increases in rent, food prices, and even the cost of essential services. Critics argue that while wealthier households may absorb the added costs, low- and middle-income Canadians are disproportionately affected, turning a climate policy into a serious equity issue. At the same time, businesses face mounting pressure to adapt or risk shutting down, particularly smaller operations that cannot afford to upgrade to greener technologies overnight. The tension between environmental goals and financial realities has sparked heated debate across the country. So what can Canadians do to lessen the burden of higher carbon costs? One option is to explore government rebates and incentive programs, many of which provide cash back for investing in energy-efficient appliances, electric vehicles, or home insulation upgrades. Another strategy is to reduce personal energy consumption through lifestyle adjustments, such as carpooling, switching to public transit, or lowering household heating when possible. Some experts also suggest investing in renewable energy sources like solar panels, which may carry upfront costs but reduce long-term bills. Staying informed about upcoming carbon pricing adjustments is equally important, as planning ahead can help families budget more effectively. While these new laws may feel heavy-handed, smart choices and proactive planning can help Canadians maintain financial stability in an era of rising environmental costs. Number 3. New housing regulations. Canada's ongoing housing crisis has pushed the government to introduce tough new housing regulations, and these rules are reshaping the way Canadians buy, rent, and invest in property. The most notable change involves restrictions on foreign buyers, designed to cool down overheated markets in major cities. At the same time, certain provinces are rolling out higher property taxes on secondary homes and investment properties. While these laws aim to make housing more affordable for locals, they also create challenges for current homeowners and future buyers. For renters, the impact may be indirect but equally painful, as landlords facing higher costs could pass those expenses down through rising rent prices. The ripple effects of these regulations are already being felt. Real estate experts note that reduced foreign investment could slow down market growth, leading to declining property values in certain regions. For those banking on selling their homes at peak value, this represents a potential financial setback. Developers, too, are feeling the squeeze, as stricter rules and rising taxes reduce their incentive to build new housing projects. This could actually worsen the supply shortage in the long run, creating an even tighter market for first-time buyers. Critics argue that while the government is trying to solve one problem, it may unintentionally create another, a stagnating real estate market paired with higher living costs. With fewer opportunities to build wealth through property, Canadians may be forced to look for alternative ways to secure their financial futures. So how can individuals navigate this changing environment? Financial advisors recommend locking in rental agreements where possible, especially in cities where demand continues to rise. For homeowners, reviewing the potential impact of higher property taxes and setting aside reserves for those added costs is crucial. Some Canadians may also consider moving outside major urban hubs, where regulations are less restrictive and housing remains more affordable. Another option is to diversify investments beyond real estate, balancing your portfolio with stocks, bonds, or small business ventures. By staying informed and flexible, Canadians can adapt to these new regulations without losing control of their financial well-being, even as the rules of the housing market continue to shift. Number 2. Wealth tax on high-income earners. Canada is moving closer to introducing a wealth tax, a policy aimed directly at high-income earners and individuals with large asset portfolios. Unlike income tax, which applies to the money you earn each year, this new law targets the value of what you already own, from real estate and luxury vehicles to investments and even art collections. The government argues that this is a way to ensure the rich pay their fair share, especially during times of economic strain. But critics point out that this type of taxation could discourage entrepreneurship and drive wealthy Canadians to move their money, or themselves, out of the country. For ordinary citizens, the fear is that today's tax on the rich could gradually expand, eventually hitting the middle class. The potential consequences of a wealth tax ripple far beyond millionaires. Real estate markets, for example, may feel the pinch as wealthy investors reduce their holdings, creating sudden drops in property values. At the same time, small businesses that depend on affluent customers could see reduced spending, hurting local economies. Economists warn that the overall impact may not be as simple as shifting money from the wealthy to public services. Instead, it could trigger capital flight, investment slowdowns, and long-term damage to Canada's economic growth. For younger Canadians aspiring to build wealth through real estate or investments, the changing tax climate may feel like the rules of the game keep shifting against them. So how can Canadians prepare for the arrival of this new tax? Experts suggest taking a close look at your asset structure and considering strategies such as trusts, diversified international investments, or restructuring ownership to minimize exposure. For those below the wealth threshold, it's still wise to follow these developments carefully, since today's policies often set the stage for tomorrow's broader regulations. Another useful step is to build stronger financial literacy, so that no matter how tax rules evolve, you have the tools to protect and grow your money. While the wealth tax is designed to target the top earners, its ripple effects mean every Canadian should pay attention to how this law reshapes the financial landscape. Number 1. Digital Services Tax Expansion. In the digital age, Canadians rely heavily on streaming platforms, apps, and online subscriptions, but these everyday conveniences are about to get more expensive. The government's new digital services tax expansion introduces additional charges on popular services like Netflix, Spotify, Amazon Prime, and even certain gaming platforms. At first glance, a few extra dollars per month might not sound alarming, but when multiplied across millions of households, the cost becomes substantial. For families juggling multiple subscriptions, the total annual impact could easily stretch into hundreds of dollars. This law reflects the government's push to capture revenue from the booming digital economy, but for average Canadians, it feels like yet another squeeze on their already tight budgets. The effects of this expansion go beyond personal entertainment. Small businesses that rely on digital tools, from cloud services to online advertising platforms, may also face higher operating costs. Entrepreneurs, content creators, and freelancers who depend on these services to run their businesses could see their profits shrink as subscription prices climb. Economists warn that this tax may discourage innovation and slow down Canada's digital transformation by making it more expensive for companies and individuals to stay competitive. Critics argue that instead of supporting digital growth, the policy risks creating barriers, leaving Canadians paying more for fewer opportunities. Even students who use online learning platforms could feel the weight of rising costs, turning essential educational tools into financial burdens. So how can Canadians adapt to this new reality? One practical approach is to bundle services, as many providers offer discounts when multiple subscriptions are grouped together. Another option is to rotate subscriptions, for example, keeping only one or two platforms active at a time instead of paying for all of them year-round. Families may also explore free alternatives or community-based options for entertainment and learning. For small businesses, carefully auditing digital expenses and negotiating with service providers could soften the blow. Ultimately, staying proactive and mindful of which services truly add value can help Canadians manage the financial impact of this expanding digital tax, ensuring their money is spent where it matters most. Canada's financial landscape is changing faster than ever, and these 10 new laws prove just how deeply the government's decisions can reach into everyday lives. From rising taxes on digital services and luxury goods to stricter banking rules and unpredictable retirement changes, Canadians everywhere are being forced to rethink how they spend, save, and protect their money. For some families, these laws may feel like small inconveniences. But for millions of others already stretched thin by inflation, housing struggles, and mounting debt, even a few extra dollars each month could be the difference between stability and hardship. While policies may seem overwhelming, the power lies in preparation and awareness. Staying informed about these laws, adjusting your financial habits, and planning ahead are the strongest defenses Canadians can use to shield themselves from the growing pressure. Remember, laws are constantly evolving, And the best way to protect your money is to stay engaged and proactive before these changes take effect. So, whether you're a student, a business owner, or someone simply trying to build a secure future, the lesson is clear: the rules are shifting, but with knowledge and smart action, you can still stay in control. Which of these laws do you think will hit Canadians the hardest? Share your thoughts below. Your opinion matters. If you want even deeper insight, watch our previous video on Canada's housing market crash 2026. We put an incredible amount of effort into bringing you these updates, so please support us. Hit that subscribe button. It's just one click, but it means everything to us.